So let's start learning about the percent B oscillator. Now, you should have a pretty good idea of what oscillators are if you've been through the foundations of stocks and options. And the percent B oscillator is going to be very similar. Again, the difference is that it's taking that information as a derivative of those Bollinger Bands. Let's learn about it here. This is an oscillator based on the Bollinger Bands, and what it tells us is it specifically tells us where we are in relationship to the Bollinger Band. Now, this is a little bit different than some of the other formulas that maybe you've seen before. When you think about oscillators, usually you're thinking about oscillators telling us where we are in relationship to the stock. What this oscillator is going to tell you is where the stock price is in relationship to the Bollinger Band. And what's great about it is it gives us signals like you're used to seeing with your typical oscillators, with your RSI, with your stochastics, but it's doing it from a totally different calculation and different formula. Let's take a look here. Notice on this chart here of Exxon, if you see you obviously see the Bollinger Band here. And as we push into the lower band, as you see over on the left side of the chart, notice the oscillator is way down here at the bottom because that's the reflection of where we are relative to the Bollinger Band. And then as we start to pull higher inside the band, you notice how this oscillator starts to come up as well. Then we get to the top of the band and the oscillator is back up here to the top. And so you can see the benefit that we have here. What it's doing is it's starting to plot along that oscillation factor, kind of that sine wave that you're used to seeing with oscillators. It's plotting it, but it's based on, of course, the relationship there to the Bollinger Band. If you look back at the same chart, if you look, as we cycle down here to the bottom, we're back at the oversold conditions, and we cycle up and we get into this trend, and we're back up here into overbought conditions. And then something you're going to notice here, look here, we make a higher high and then a higher high, but look at your oscillator, it's making lower highs. There's that coveted divergence. And that's one of the great signals that we do get here with the percent B. Percent B gives us very solid signals like you're used to getting with, say, for example, your RSI or with your stochastics, but again, it's going to be put inside this framework of the Bollinger Bands. Divergence in particular is one of the signals that's really, really good at giving us. So let's take a look over here at a few data points. When we think about the formula for the percent B, the formula is actually a formula that you might be familiar with. Here's what it looks like. It's the last price minus the lower band divided by the upper band minus the lower band, and that equals the percent B. Now, if you are familiar with stochastics, you're going to recognize that this is actually the same formula that is used to calculate the stochastics, but instead what Bollinger's done is he's taken that and he's applied it to the band. So he's replaced the last price for the end time period, and he's just altered the numbers a little bit here, but the formula itself is just the exact same formula of what we would typically use to calculate a stochastics indicator, but instead, again, we've applied it here to the Bollinger Bands. Now, let's talk about some of the range definitions. It's really important when we understand oscillators to have an idea of what that range is. If you remember back to your Foundations of Stocks and Options training, you should remember that oscillators typically come in two forms. You've got a range-bound oscillator that's going to cycle between 0 and 100, and then you're going to have a non-bound oscillator that's typically going to cycle over what we call a zero line. For example, the MACD oscillator is a zero line in the center there. It's a non-range-bound oscillator. Well, the percent B is kind of a hybrid there. It's going to look like it's the RSI or the stochastics. It's going to oscillate the same way, but it's not got a definite range to it. It has a definite high and a definite low, but it can move outside of that. And in fact, when we move outside of that, we're getting outside of that standard deviation. We see that reflected there in that percent B. Let me show you how the formula works here. Percent B is not range bound. In other words, there is no definite end to it, but there are definite settings, and here's what they look like. If we are greater than 1, then the stock is reading above the upper band. Now, what does that mean to be reading above the upper band? It means we're outside of that standard deviation, so it's relatively speaking quite high. In fact, it's way too far away from the average of what we've been trading at. So whenever you see a reading above 1, you know that you're going to be, relatively speaking, rather overbought on this particular trade. Now, if we get down to 1 itself, if the percent B is reading right at 1, then the stock is right at the upper band. And if we go to 0.5, then we are at the middle band. If we get down to 0, then we're trading at the lower band. And if we're below 0, then we're very oversold because we are below the lower band, meaning we're on the opposite side now. We're beyond the standard deviation, below where we should be. So let's come over here and let's take a look, and I'll show you a couple of examples here. Notice right here we're well below the lower band, and look how oversold we are on the oscillator itself. Then what happens? Immediately the trade has to go sideways for a little bit here to get back inside the bands. Now that we're back inside the bands, the trade can continue, but before you know it, we're back outside the bands, we're oversold again. And once you start to see that, you know that you can't sustain this very long. And so certainly, very quickly here, the trade starts to go sideways, and then ultimately we start to have a reversal here. So now let's take a look at the next point. If you notice right as we are at the band itself, you see we're right at the band here, and look at how the oscillator is right at 0. And so that's the way that's going to read. Now if you move over to the middle band, as we're crossing up into the middle band, the oscillator is reading right at 0.5, which is right in the middle of the possible range. If you wanted to put some other ranges to this, you could call 0.5 the 0 line. That's the way a typical non-range-bound oscillator would work. It's just that we've titled this 0.5. That's the value that they've assigned to it. But it's still the principle of the 0 line that you're oscillating around. And then if you cycle up here to the top, notice right as you're at the upper band, look at how, well, this closing price was a little bit below the upper band, but right as you're up at the upper band, you're up towards the 1 reading on the oscillator. We bounce back down here to the 0.5, or back to the middle, I should say, and we're back at 0.5. Now, if you come over here to the right side, notice the extremes that we've got. We've pushed well beyond the band here, and we're above 1, so that becomes a very overbought reading. And so immediately, I mean, usually it's within a day or two, when you're that far outside of the band, usually within a day or two, this thing's going to at least correct a little bit to get back inside the band. And then notice right here on the far right side, we're closing right on the upper band, and look at the oscillator. It is right on the 1 reading here of the %B. And so the settings are pretty straightforward. It's pretty easy to understand. Once you've looked at it a little bit, the interpretation is not really that odd. In fact, it's quite straightforward. Again, it's kind of a synthesis of that idea between the MACD that does not have any range bound to it, and the stochastics that is going to be range bound. And again, it's also built on that stochastic formula. Now let's talk about the signals that we get with %B. With %B, there's a couple of signals that really matter. All oscillators, as you should know, are going to reflect typical overbought, oversold settings. %B is no exception. And then the additional one that you're going to see with %B is divergence and convergence. These are going to be the two signals that we primarily get with %B. They're typical oscillator signals that we're used to seeing with your RSI, your stochastics and whatnot. And it's just giving us the exact same signals, but again, the formula of how we get there is derived from those Bollinger Bands. If I come over here and look at a chart here with Exxon, you're going to notice a couple of examples that we just had. As we push outside the upper band, look, we're very overbought. Now the next thing that happens is we keep pushing up into the band, but notice we're not outside the band. We're kind of slowing down a little bit, and look at your oscillator. It's going downhill. There's your bearish divergence. And so what happened following the bearish divergence? Well, it turns out that Exxon started its reversal here. Now look at the one over here on the next little bulge that you've got going. Look at how we've pushed outside the band. We're very oversold, and we keep pushing outside the band. We're still oversold, but it's not at the same rate. And then, of course, that leads to the next move. This is a typical type of divergence that you might see with %B. A lot of times your divergences will line up with a double top or a double bottom or an M pattern or a W pattern. Sometimes it will look like this right here, where inside the trend itself, part of the trend's pushing outside the band, part of it's not, and you see that slowdown in momentum. You start to see that divergence, and that oftentimes will lead to that reversal that you're looking for there. Now, that kind of sums up all your basic principles of the %B. Again, it's your typical oscillator principles, it's your typical oscillator signals, but it's taken from the Bollinger Bands. The next one we're going to look at is your bandwidth, and we're going to see how the bandwidth can play a major indication in terms of what's happening with the spacing between the bands.